Warren Buffett. The name is legendary, right? You know the success story. But how did he actually do it? How did he build this colossal empire, seemingly from scratch? Well, it wasn't some secret algorithm or a complicated formula locked in a vault. It was a philosophy, and today, we're going to decode it.
I mean, really think about that question. We're not talking about just getting rich. We're talking about a level of wealth creation that has left the financial world scratching its head for decades. He literally started with pocket money and built one of the most valuable companies on the planet. How is that even possible?
And just to put some numbers on it, to give you a sense of the scale here, he started with just $100 back in 1956. By mid-2004, his personal net worth had exploded to over $42.9 billion. That's not just a good return, it's astronomical. So, what's the secret sauce?
And here's the most important thing to get right from the start. It is not a secret recipe. You can't just copy and paste it. It's a mindset. It's a whole way of thinking about businesses and markets that's incredibly disciplined, patient, and, deeply rational. And the best part? It's a philosophy that anyone can actually understand. So, where did this philosophy even come from? Buffett didn't just invent it out of thin air. He was a student of the greats. He stood on the shoulders of giants, really, taking the best ideas from some of the sharpest financial minds and blending them into his own unique approach.
There were three key influences in his life. You've got Benjamin Graham, who gave him that solid foundation in value investing, all the quantitative stuff. Then there was Philip Fisher, who taught him to look beyond the numbers, to really dig into the quality of the business and its leaders. And then, the ultimate catalyst, his partner Charlie Munger, who helped him evolve his thinking into something even more powerful.
Now this slide right here captures the single biggest shift in Buffett's entire career. See, his mentor Graham was all about buying cheap stocks. Any fair company would do, as long as the price was wonderful. He called them cigar butts, one last free puff. But it was Charlie Munger who convinced him to flip that idea on its head, to focus on buying wonderful companies, truly excellent businesses, even if you have to pay a fair price for them. This was an absolute game changer.
Okay, so that's the philosophy. But how does he actually put it into practice?
Well, it all comes down to a really clear four-part framework.
Think of it like a mental checklist he runs through for every single investment he considers. And here they are, the four pillars of his entire analysis. First, he looks at the business itself. Then, he scrutinizes the people running the show. After that, he dives deep into the company's financial health. And only then, only at the very end, does he even start to think about the price. So let's break them down.
So first up, the business tenets. Buffett asks three really straightforward questions. 1, can I understand how this business makes money? Is it simple? 2, does it have a long, proven track record of success? And 3, does it have a durable competitive advantage, what he famously calls an economic moat that protects it from the competition? Think about a brand like Coca-Cola. That's a moat.
And this first tenet leads directly to one of his most important rules: stay strictly within your circle of competence. He doesn't have to be an expert on every industry, not at all. He just needs to be brutally honest about the boundaries of what he does know and then never, ever step outside them. This is exactly why he famously set out the whole dot-com bubble. It was outside a circle.
All right, next up, management. For Buffett, you're not just investing in a business, you're investing in people. He needs to know, are the managers rational with the company's money? Are they totally honest and upfront with their shareholders? And crucially, do they have the guts to resist what he calls the institutional imperative, that mindless tendency to just copy whatever their competitors are doing?
And this quote, well, it says it all, doesn't it? The quality and the integrity of the people running the business are completely non-negotiable. It doesn't matter how cheap the stock is or how great the business looks on paper. If he doesn't trust the management, he walks away. Period. So, once a business passes the business test and the management test, now we can finally talk about price. And this is the final pillar, the value tenet. This idea comes straight from Ben Graham, and it's called the margin of safety. Basically, you figure out what a business is actually worth, its intrinsic value, and then you insist on buying it for way, way less. That discount, that gap, is your margin of safety. It's your ultimate protection against being wrong.
So we've seen how he picks his investments. But what about how he manages his portfolio? Well, this is where he really goes against the grain of modern finance. It's pretty controversial stuff.
You know how every financial advisor on the planet tells you to diversify, spread your money across hundreds of stocks? Yeah, Buffett thinks that's kind of crazy. He does the exact opposite. He practices what's called focus investing. He makes huge, concentrated bets on just a handful of companies that he knows inside and out. His reasoning? Diversification is for investors who don't know what they're doing. Ouch.
So, if he's not diversified, how on earth does he handle the market's wild ups and downs? Well, he uses another one of Ben Graham's brilliant little stories. Imagine the stock market isn't a ticker tape, but a person, a business partner named Mr. Market. And the thing is, Mr. Market is manic depressive. He's emotionally unstable. So every day, this moody partner of yours shows up and offers you a price. Some days he's euphoric and offers to buy your shares for way more than they're worth. Other days he's terrified and offers to sell you his shares for pennies on the dollar. And here's the beautiful part. You can just ignore him. The wise move is to use his craziness, not get swept up in it. When he's panicking and offering you a bargain, you buy. When he's greedy, maybe you sell. See? Market volatility isn't a risk to be avoided, it's an opportunity to be exploited. Okay, so we've looked at his mentors, his four-part method, and his discipline. If we had to boil all of this down, what's the single most important lesson from the Warren Buffett way?
It all comes down to this single, powerful idea. You have to think like you are buying an entire business, not just a little piece of paper that wiggles around on a screen all day. Every decision has to be seen through the eyes of a business owner, not a stock market gambler. So how do you actually develop that mindset? Buffett says it's pretty simple. First, you have to learn to ignore the constant noise from the stock market. Second, stop worrying about what the economy is going to do next year or next month. And third, put all of your energy into one thing, understanding the fundamentals of the business you are thinking of buying. This quote right here just perfectly wraps it up. If you can fundamentally shift your perspective from being someone who rents stocks to someone who owns businesses, your entire approach will change. Everything will change, for the better. So I'll just leave you with this final thought experiment. Imagine you were forced to put all of your savings into one single business, and you had to hold it for the rest of your life. No selling. How would that change things? How much more research would you do? How much more would you care about the quality of that business and the people running it? That's the level of seriousness and long-term thinking that really defines the Warren Buffett way.